this afternoon's webinar looking at providing proactive tax advice in spring 2020. Proactive tax advice has changed because obviously coronavirus has changed so much. Today I am joined by Simon Britton of Quantify to look at proactive tax advice in the face of coronavirus. So welcome to everybody who's joining us here, and to those of you who are joining us on Zoom, but also those of you who are joining us as we stream live into Facebook, YouTube, LinkedIn, and Twitter. So if you're joining us here live, please, if you have questions as we go through this session, if you have questions, please ask them below in the chat box. If you're joining us on any of the other platforms, Simon has a very detailed and comprehensive presentation prepared, but we have allowed some time for questions and answers. And if questions come in during the session that are relevant, Simon and myself see them here so we can have a conversation with Simon and ask the questions for you. So if you're live here in the webinar with us, but if you're anywhere watching, just put your comments, your questions into the comment box, and the team are going to pick them up here. Now, the next thing is the presentation for this session and the slides to go with this session. So again, Jonathan is posting a link at the bottom of the page, either in the chat box or in the comments, so that you can access your downloads and material. Some of the questions we may leave till the end, but please ask the questions as they arise for you. One of the huge values of something like this is Simon is unquestionably a category authority. Simon is a tax expert. You have somebody here as a captive audience, a captive expert. So if Simon can answer your questions, when you ask a question, everybody benefits. Simon, welcome to our webinar today. Simon, can you introduce a little bit about yourself first before we get stuck into the material, and why people should listen to you? What does Simon Britton have that's going to be of benefit to accountants and firm owners?
Brilliant. Yeah. Hi, Des. Thanks for having me. And hello, everyone. I hope everyone's not struggling too much with lockdown, and looking forward to getting back to work. So I'm Simon Britton, and so today I'm talking about tax advice and what we can do proactively to help our clients in the current environment. My background, I'm actually I've got far too many qualifications that my CV reads like a sign of a wasted youth. So I'm a ATT, CTA, solicitor as well. So I've spent far too long specialising just in the world of tax, and in particular in proactive planning, helping people, generally OMBs, look at their circumstances, look at the family, look at the business, and let's make sure that we can get all of the various taxes that come into play, get them all in sync. And so I've picked out a couple of the juiciest bits that I think that as a profession we can take to our clients at the moment and really be on the front foot.
So, Simon, you mentioned in there that you've also qualified as a solicitor. A very interesting combination. Did you spend long practicing as a solicitor, or was it another string to your tax bow, Simon?
So yeah, I've been practicing as a solicitor for about 15 years of the last 20. So I've spent some time purely in accountancy firms, some time just in tax, other times just in law firms. But what I find is there's a big disconnect between the accountancy profession and lawyers, and so I try and bridge that gap. And so when we've got tax thinking that needs to be implemented, that's really where I come in and just make sure that the legal work that's done really sort of ties in with that. But then on the other hand as well, I'm kind of also reinventing R&D tax services as a software-driven thing as well. So I'm doing too many things.
Not at all. The sign of an expert and an inquisitive mind. And that's what we want when it comes to tax, is inquisitive minds. So folks, anybody who came in late, in the comments below or in the chat box below, Jonathan has put up the downloads for today's session. We're just kicking off. We've just finished our introduction, and we're now moving on to the teaching space. which Simon is going to bring us through in the next 45 to 50 minutes through his material, and then we will wrap up the session. So Simon, over to you if you want to bring up your presentation and share your screen.
Great, let's do that. Okay, so you know what? If JR, if you're still there, if you could enable screen sharing, that would be a big help.
That would be a big help. So hopefully you should be able to do it there now.
Yep, that's the one. Excellent. Here we go.
There's new features appearing every day on Zoom, and there's new downloads. So our standard operating procedures from yesterday are possibly redundant by today.
Yeah, it seems ties in with the government advice around handling this coronavirus. Just every day is different, but great. So we're going to be talking proactive tax planning in the current time, and I flicked through far too many of the slides there. So let's just see if I can get back to number one. Here we are. Sorry, right, number two. Here we go. Brilliant. So let's dive in. So what I've done today is I've tried to pick out two areas that are really going to help your clients get money into their businesses. That's got to be the absolute top priority at the moment, is how do we get money into businesses where people have had so much disruption through the coronavirus. And I think overwhelmingly, a lot of the businesses that I talk to say that they see the current time as a blip. They expect in 6 months, 9 months, a year for the world to have sort of righted itself and for it to be, to an extent, business as usual again. So what they need to do to bridge that gap is get some more money into the business, and money that perhaps wasn't in their forecasts before the coronavirus hit. So we're going to look at a couple of ways of potentially doing that. What I really want to emphasize is all the corona support that accountants are doing at the moment is great, and definitely stick with that, do that first. The government support's been very good. Some of it's been a bit clumsy in terms of the implementation, but generally what they're doing is it absolutely should be the top priority. So what I'm going to talk about is what to do next. When you've done that, what do you do next? And it's good to know that you've got a couple of things in the bank on the agenda to speak to clients about. So we're going to talk about SaaS pensions, and we're not going to go too heavy, so don't be too worried about that. And R&D claims, both of which are great ways of getting some money into businesses. So yeah.
For anybody that's joining us here live on Zoom, folks, you can adjust your screen view options. You can adjust your screen view options to make the slides bigger, to have Simon to do a gallery view. So make sure and play with your settings wherever you're watching to get the view that you want.
Great. Yeah, so SaaS is the first topic that we're going to tackle. This one is, it's about business pensions, and so they're really designed for OMBs. So the maximum number of members that you can have in one of these is 11 members. So it's designed for that smaller type of business, not for a huge client. There are other things that we can look at there, but this is really good for most of the businesses that we tend to be dealing with. A SaaS, just to explain the terminology, that stands for a small self-administered scheme, and it's different to a personal pension. So a personal pension is heavily regulated, as it should be, by the Financial Conduct Authority, and all of the rules around a personal pension relate to the fact that it is an individual pension. One size has to fit all, and so there's blanket regulation across how they operate. With the SaaS, which is this small self-administered scheme, because that's a business pension designed for OMBs, it's designed to be handled by entrepreneurs, and so there's a different balance of risk and reward than you would have for just sort of the one size fits all available to every member of the public type personal pension. So a business pension has a couple of key features that are really important for the type of planning that we're going to talk about. The first one is you can borrow 50% of your pension fund from a SaaS. And because the people in the SaaS, the members, are also the trustees, and it's the same person who runs the company, is in charge of the pension and will benefit from the pension, then the regulation here just allows you to sort of take more of a balanced risk and reward approach, and to look at your own business and think, well, you know what? I'm going to lend half of my pension to my business because I back myself to be able to make money using my pension fund. I'm going to make more money doing that than I am by investing in stocks and shares or whatever else. And so there are a lot of rules around what this loan has to look like, and we'll talk through those in a little bit more detail later on. But the other thing that you can do as well that we're going to touch on today is contributing a commercial property into the pension. And that's a fantastically tax efficient thing to do. But the other thing that's really pushing this up the agenda for people at the moment is that once a commercial property is outside of your company and in a pension, it's secured in that trust environment. If there were to be financial problems with the company in the next sort of year, 2 years, 3 years, however long, the property is actually safe. When it's outside of the company and in the pension, it's outside of the reach of creditors. So that's an important point, that a lot of clients are quite reasonably concerned about just asset protection at the moment. And the SaaS can help with that, as well as giving you great cash boost and some tax benefits as well. So we'll talk through those in a little bit more detail now. So I've put this up as accessing your existing pension funds. Now, accessing pension funds, this is a world away from liberation. We're not talking about pension liberation. We're not trying to permanently strip money out of a pension. What we're saying here is that the money that's sat in the pension, you can actually use that as working capital in your business. Not all of it, it's only 50%. You do have to still make sure that your pension is well provided for, but 50% of what's in your pension pot can be used in the business. And excuse me. If you look at a typical situation, might be that an owner manager might have a business that's sat there. They might have squirreled away, say, £200,000 into a pension pot that sat there with the money being managed by a financial advisor, and they're getting a return on it, but they're not using that money. And typically people aren't that excited about whatever's going on with their money, so long as they get a return and they're kept kind of up to speed on that. Then yeah, they forget about that money. But what they could be doing is accessing that. So if someone's got that £200,000, then this is a way of them getting £100,000 of it into their business as working capital. Has to be repaid back into the pension, but typically over a 5-year period. But when the money goes back into the pension, they've lost nothing in terms of the value of the pension. But they've had the benefit of that, of effectively very cheap money in the meantime, and money where they're not having to go to the bank, they're not having to explain their business proposition and do cash flows and all that sort of thing, because they're effectively both borrower and lender. It makes it very easy. So what I've sketched out here is
valuation, Simon. Does that need to be carried out by somebody independent, or if I'm the accountant to my client, is it appropriate for me to do that valuation? And does there need to be a formal process and formal report here?
Absolutely. It's the valuation that's something where I would actually encourage the accountant that's dealing with the client here to be the one that puts that valuation together. It doesn't have to be independent. It has to have some substance to it, of course. But what we're trying to do is, just make sure that that the value of the company shares, typically it would be the company shares that there's some security taken over for for the pension, just that the value at least exceeds the amount that's going to be borrowed. So if someone in a typical scenario, someone might have £200,000 in a pension, wanting to borrow 100,000, we need to have a valuation that says that the shares are worth at least 100,000. So it's not the sort of very far-reaching valuation exercise that's sometimes needed. This is one that really can be done by someone that knows the business very well and follows a sort of fairly standard methodology in putting that together. So yes, so the various steps involved. The longest part is getting the SaaS set up. So that's something that the company needs to engage a SaaS advisor to set that up. Typically takes 3 to 6 weeks. A lot of that just depends on how complex the applicant's tax affairs are. But if you've got a fairly straightforward tax record, then yeah, we'd expect that to pretty quickly. At the moment, the revenue are doing these in sort of 3 to 4 weeks. Sometimes it does stretch out a bit longer, and odd cases, if one got sort of a complex tax history, then it can take sort of a couple of months, maybe 3 months. But that sort of time period is what we usually say for people to budget towards. So if you are looking to get a corporation tax deduction on pension contributions, then you need to factor in that sort of gap, start this process a good couple of months before the year end. But yeah, so setting a SaaS up is reasonably straightforward, not massively expensive. That's something that my business can help with. Taking you through that process, and also most of the rest of the implementation of this. SaaSes are often something that it's in that sort of dark spot where people are aware of it and probably did some of it in their exams, will have read some articles on it, but actually implementing these things isn't something that many of us as advisors do on a day-to-day basis. So really that's where sort of SaaS law, the one of the hats that I'm wearing today, that's the one that sort of implements this every day and can make this a really smooth package. So once the SaaS is set up, then it can get a bank account. That usually takes a week or two. So again, that sort of just slows the process down a little bit. And then once the bank account's set up, the personal pension, so if people have got money just in a normal pension or in a SIP or something like that, if that's the funds that they want to access, we can move the personal pension funds into the SaaS. And at that point, you've got this ability to lend it into your own company and also make whatever other investment decisions you want within the bounds of the regulation. But it's the owner manager themselves that would be the trustee and would be able to direct the investment strategy, which might well be, I'm going to borrow half of the money back out into my own business, and the rest of it's just going to get reinvested where it was, and that's fine. To allow the loan to take place, there needs to be some security. Typically, that's over the shares, but it might be over a property. So there needs to be a valuation exercise done on that, just to satisfy the trustees that the security has the valuation, enough of a valuation to cover the extent of the loan. That exercise is normally overlapped with setting up the SaaS, as is drafting up the pension loan agreement, which is on fairly standard terms. The interest rate can be set either high or low, depending what you want to do. Typically, we would suggest putting it at the upper end of the sort of bracket of reasonable rates, because the company's going to get a tax deduction on the interest, and the pension's not going to pay any tax when it receives that interest. The company grants security over its shares, which again, that's a process that we take care of. That's overlapped as soon as the loan is entered into. That paperwork's ready to go, and that can be executed at the same time. And then 50% of the pension value is transferred into the business. So as soon as the money's available and the paperwork's signed, that bank transfer can happen same day. So actually, this is a pretty quick way of getting money that into the business that you know you've got in the background that's not otherwise being employed in perhaps as good a way as you could if you had it in the company.
I mean, you said something I think is really critical a few minutes ago. And it's about, I would describe it as sticking to the knitting and sticking to what we're good at. So accountants have core competencies. Some people have different competencies, but knowing what our boundaries and our limits are. In doing something like this, what are the risks? Where does this go wrong for somebody like me who's not an expert in SaaS and hasn't been through the process, maybe only has an academic knowledge? What are the mistakes that people make, and what are the horror stories that you've seen?
So there's SaaSes are sort of fairly tightly regulated. There's only certain types of investment you can do with them, and you have to make sure that that you're sticking within the regulations. If something goes wrong, then yeah, the penalties are savage. So there's no point pretending otherwise. This isn't something to try yourself. So there are advisors out there, myself included, that can steer people through this properly. The principles are great, but actually getting the implementation right, that's the sort of the bit where you're going to save yourself from ending up in hot water. One of the areas that people fall down on a lot is with this type of arrangement where a loan's being made from the pension into the company. You actually have to repay that loan. It has to be done with an interest rate. The interest has to be paid as well. You've got to make at least annual repayments on that capital and interest to get it back. So you can't just lift the money out of the pension and forget about it. It has to be worked through properly. And there's lots of as you'd expect, returns and regulation that needs to be met. But yeah, working with someone who does this as their day-to-day job, someone who really knows the rules inside and out and's got their finger on the pulse, that's where you stop yourself from going wrong. So yeah, I think it's a case of just pulling in the right people for the right roles. And this is one of those things that if it's not something you're doing every day, then give it to someone who is doing it every day. I think typically the way that I see the accountants performing best when they're doing tax planning that involves something slightly off the beaten path is to really be aware of the opportunity, and then to have that relationship with the client to be able to say, I think this could work for you, and then to bring someone in who can implement it, but to work together to make sure that we're not just implementing something standard, we're implementing something that's really just tailored to meet the exact needs of that client. So yeah, just to finish off on this slide, the company has to repay that loan plus interest, and that's typically done over 5 years. So I just want to run through a worked example of this, which won't take very long to run through, but I think it's useful to kind of bring it to life and illustrate it a bit. So David had £200,000 in a personal pension in a SIP, and that money, his company has £75,000 borrowing on a machine, and he's paying 8% interest on that. So that's a pretty typical scenario. So to tackle this, what he does is sets up a SaaS, moves the money from the pension into the SaaS, and then lends half of it, so 100,000, comes from the SaaS into the company, and that's at a 10% interest rate, which could have been higher or lower, but we picked 10% there just to get some money back into the SaaS. So Dave's company repays the borrowing on the machine, so that's £75,000 repaid. It's effectively replaced the external borrowing with borrowing from his pension. So that interest is no longer leakage. That interest is now going into his pension, and it's there for the future. And then he also paid himself a bonus of £25,000. So he's personally quite happy as well. That's taxable, obviously, but he can fund a pension contribution with that if he wanted to. But yeah, so something like this can just where there's an obvious benefit for the individual involved. The business is going to be better off, but also if he manages to get a little bit out of it himself along the way, then that's something that clients really do value in difficult times. And that quite often is something that could just be loaned back into the business to clear an overdrawn director's loan account, or just to create a credit on a director's loan. The loan gets repaid over 5 years, so there's £10,000 worth of interest that's paid into the SAS. That's received tax-free, so the SAS has got that 10 grand. That gets invested for the future as well. So Dave's pension pot is now looking as healthy, if not more healthy than it was before. The business is better off, and then he's personally had that bonus as well. So it's a nice little outcome there for everyone, and that's something that can be set up and implemented pretty straightforwardly.
When we go back to your previous slide, you're talking about in total you're looking at from start to finish. You can probably get this done in 12 to 15 weeks.
Yeah, it's the quickest that I've seen this particular variant of it implemented was probably about 5 weeks. But then, yeah, the other ones, if the revenue is slow setting up the scheme, and then if the people that the current pension provider, if they're slow at allowing the transfer of money across, then yeah, you can be looking at something like probably 15 weeks there.
Is it beyond the scope of today's presentation, Simon, to talk about the restrictions on the SAS in terms of, you said they're quite tightly regulated and there's only certain things you can invest in, certain things you can do. Am I opening up a can of worms by asking that question?
No. It's well, yes, but we'll answer it briefly, and then yeah. But I want to give people sort of the awareness there is an awful lot of subtlety and nuance to the rules. But broadly, what we're looking at is it's got to be a proper investment. So you can't spend the money on cars and holiday homes. It's got to be something where it's generating an investment return that's really designed to, the investment has to be something that's designed to provide you with a pot of money in retirement. Commercial property is brilliant, and we'll talk about commercial property and the pension on the next few slides. But yeah, commercial property is a cracking investment to have in this kind of SAS. You can't have residential property. And then the other thing that people do a lot with it, loans to third parties. So you might see a third party that's offering an attractive interest rate, and again, that's something pretty common on property developments. Stepping in with a bit of finance can often be short term and generate good returns. So that's something that people do a lot with this. Lending money into your own business, that's fine. You are allowed to do that with the SAS. You'd never be allowed to do that with the SIP. And then investing in stocks and shares in the usual way, that's allowed too. So yeah, it's got to be a proper investment, and yeah, no residential property in there. So it's no buy to let. If you ask about student property, that's where we get into a can of worms kind of area. So we'll leave that one for another time. But yeah, if anyone wants to sort of explore particular, can this be invested in? Can that be invested in? Very happy to do that separately or afterwards. So yeah, we've been through the examples. So the next one that I want to look at, this is moving a commercial property into a pension. And the aim of this is both the security aspect that I touched on earlier, to make sure that the commercial property is safe from creditors if anything was to happen in the future in terms of the financial stability of the company. But also the tax relief that you can get on moving a commercial property into a pension is massive. So this is something that's often overlooked. If a company's got a commercial property on its balance sheet in the company, then yeah, if we move it into the pension, then I'm going to talk through how we do that and how we get a corporation tax deduction on the value of that property. So again, just to start off, the company has to set up a SAS pension. So you're looking at the 3 to 6 weeks there, get a valuation of the property that can be overlapped with that. Typically, it takes 2 or 3 weeks to get a valuation done. If anyone knows a valuer that can do a valuation quicker than 2 or 3 weeks, then please give them my number. But the valuations do seem to take longer than necessary. The pension makes the company makes a pension contribution that's equal to the property of the value. Now, this is something that there's a prescribed methodology for making this type of pension contribution, where we're going to move the property into the pension. And this is the process. So you have to do a pension pledge that's for an amount of money equal to the property value, or above or below, but broadly equal to the property value. So if you've got, say, £500,000 property, we're going to do a £500,000 pledge of money to the pension, but then shortly after that, the trustees would accept an offer of the property to satisfy that cash debt. And so we're not contributing the property directly. We're not saying to the pension, please take this property. We're saying, please take this property to satisfy that cash debt that we owe you. And that's a methodology that is different to what's called an in specie contribution. If you've looked at pensions over the last 2 or 3 years, you'll have seen that in specie contributions are something that the revenue is uncomfortable with because of the valuation issues. So the revenue has actually set out this way of doing things, where we can transfer a property into a pension using this approach, and this is something that the revenue readily accept and have given clearance on, that this is an appropriate method of doing it. So when you've done that, you've made a pension contribution of, say, £500,000. So you would then get your corporation tax deduction on that pension contribution. That pension contribution tax deduction is absolutely standard, nothing controversial about it at all. There are some rules about the timing of the pension contribution, the timing of the deduction that you get, depending on whether you've made contributions to a pension over the last year, and depending how big it is. Broadly, if it's a contribution up to the value of £500,000, then you can get all of that deduction in 1 year. If it exceeds that, then you might have to spread it over 2 or 3 years. If it's a contribution of over a couple of £1 million, then yeah, you're going to have to spread that out over 3 years. But you do get the full value of that tax deduction. So typically what we find with most businesses that we do this with is that actually the property value is usually more than double the profits of the business for the type of family owner managed businesses that we tend to deal with on this. So that means that that when the pension contribution's been made, when you get to the year end, the tax liability for the current year is going to be completely wiped out, and then you can actually carry the tax loss back into last year and recover some tax that was paid last year. So that will get repaid by the revenue to the company in the usual way. So that's a serious cash difference to the company.
And again, I'm sorry to come in here with the negative questions again, Simon, but I am an accountant. I'm an actual real life accountant. So I tend to look at things from all sides, and I look, okay, upside, this all sounds very positive. What's the risks here? Like I'm actually seeing a double positive here, that it's protecting. So there's a tax saving. It's protecting an asset in a company that may be coming into a period of distress. But what is the downside that I'm not seeing? Obviously there's implications of moving a property owned by a limited company into a pension fund. I'm sure there's more restrictions on getting it out and liquidating it. But what are the other risks? What are the other downsides? No,
yeah, you're right. When the property's in the pension, then yeah, it's in a different place doing a different thing. The downside that you've then got is that the company is going to have to lease that property. So it wasn't previously paying rent on the property, but it is going to have to pay a market rent to the pension. So you have got a little bit of extra cash that's going to have to keep going out, but that's cash that's coming out of the company in a tax deductible form and ending up in the pension where you're not paying tax on it. So it's not that bad. And,
so it's a downside in that now we've got to have this cash outgoing every single month. But on the upside, it's cash that's ultimately coming to us long-term, tax-free, building the nest egg for the future.
Absolutely, absolutely. So, I mean, the other downside, the one that that we need to sort of flag up, is the effect on the balance sheet. You know, if your balance sheet's got a commercial property on there, then that, you know, that's great. It's going to boost your balance sheet. If you take that off and put it in the pension, then normal scenario is that's going to reduce your balance sheet significantly, and also in the year that you make the pension contribution, that gets set off against your profits, which is where the tax saving comes from. But if in 1 year you've hit the balance sheet in a major way and you've wiped out your profits and it looks as if you've made a significant loss, then yeah, cosmetically that's something that you know, businesses might need to bear in mind how that looks. I mean, obviously we are just taking that asset and moving it from one place to another. It's all still under control, and so commercially we're not sort of significantly changing the position, but in terms of how the accounts look, the client needs to be really aware that that it's going to look like they've had a bad year, when actually what they've done is provided that security for the future, and bought themselves a big tax benefit as well. But yeah, should we let's run through an example of that, just a little quick one, just to sort of bring it to life a bit. So yeah, Jeff Co, and you can probably guess the owner of Jeff Co is Jeff. But Jeff Co owns the industrial unit that it operates from, and it's got a current value of £500,000 there. So a SaaS is set up, and using that methodology that I talked through earlier, the pension takes the ownership of the unit there, and then a lease is put in place so that the company can carry on using it. The company gets a tax deduction of £500,000 in the current year, which is on that pension contribution. So his profits, the company's profits, were say £250,000. So yeah, the current year's profits are completely wiped out by the size of that pension contribution. So he's going to save the tax that he would have otherwise had to pay on that, and then he's also got another £250,000 worth of profit, tax deduction that he can carry back in last year, recover last year's tax that was paid. So not only is he not going to pay £50,000 in tax for this year's profits, he's also getting back £50,000 that he paid in tax last year. And so, yeah, so that's a really nice position to end up in. But what's even better is this next example. So a lot of people have been advised by their accountants, and very rightly in a lot of cases, not to have the commercial property in the company, because if something goes wrong with the company, then the property is theoretically at risk there. So a lot of people have got the commercial property that the business trades from, they've got that held personally. And yeah, and that's it's not an amazingly tax efficient position to be in, because if the company's paying rent, then you're paying income tax typically at a higher rate on the rent that you receive than the tax deduction that the company is claiming on it. So but that's, you know, it's usually not a big figure that we worry about there. But we've got an opportunity in that scenario where the shareholder, director shareholder, owns the property personally outside the company. What we can do is actually move it into the company and then move it onto the pension. And by bouncing it into the company on the way to the pension, then we get even more tax relief. So it gives us the chance to create some income tax savings, as well as that corporation tax deduction, which is the same as we just ran through in the last example. So to do this, again, a SAS gets set up, the property valuation gets carried out. The company buys the property from the owner, and so to do that, typically the company's not going to be sat with all that money just sat there. So a director's loan account is created where just the purchase price is left outstanding. The company then follows very much the same steps as in the last example, where the pension contribution is made, that pledge is satisfied by the transfer of the property. The company claims its big corporation tax deduction, but then this is the sort of extra bit, the slight downside on this route is that the owner's then left with a capital gains tax liability on the property sale. And obviously if the property's worth a lot and there's a big gain there, then that can be quite a sizable capital gains tax bill. So then that would be due 31st of January in the year following the tax year in which this happens. But the owner is then left with the director's loan account that they can draw on when the cash is available in the company. And that's taxed money in effect. The capital gains tax that's paid on the sale of the property from the person to the company, that means that DLA has in effect has been taxed and then loaned back to the company, so you can take that out again.
So once you have adequate cash reserves in the company to pay the capital gains tax liability, by the time of the capital gains tax liability, your director's loan account then becomes a drawable asset, tax-free in the hands of the directors. Yeah,
absolutely. And if you were otherwise going to be taking salary or dividends from the company, then if you can replace that with drawing on this DLA, then actually, you're paying capital gains tax at a much lower rate than you otherwise would be on pulling money out of your company. So this works really well for companies where it's got a small family shareholding group. If you've got multiple shareholders that aren't necessarily connected in that way, then this needs a bit more structuring. But if it is, family business, family group of shareholders, then this works really, really well.
And the other thing is the property is really just moving through the limited company, because it's moving from personal ownership into, but then it's immediately moving on to the pension. So it is protected, but obviously we're back to the same issue. It's, well, in my own name, I've got much more flexibility as to what I do with that property, whereas once it's within the pension fund, I have limited freedom and less flexibility.
Well, if you wanted to do something with that property when it's in the pension, then you need to make sure that you're not sort of stripping any value out of the pension. So you could buy the property back out of the pension, but then you need to have the cash to be able to do that. When the property's in the pension, it's you have made that contribution. That value is locked away in the pension, and you are in a more restricted environment there. But
one thing strikes me, Simon, as you speak, is this this is absolutely fabulous in terms of opportunities. It's it's creating options. It's giving us opportunities that's relevant to right now. But it also does strike me that whatever you're doing here really does need to be part of a bigger strategy, a bigger wealth plan. That you're looking at not just this move, but you're looking at the next move and possibly the move after, to assess the implications of the longer term plan, as in a 10, 15, 20-year plan.
Absolutely. And SAS pensions are very good for inheritance tax planning as well. So, if you think very, very long term, we'd usually say, if you can, draw on your pension last, because when money's in your pension, it's outside of your estate for inheritance tax. If you start pulling on your pension, you're pulling cash into your estate. That's potentially.
I didn't verbalize it straight out because I'm not an expert in this area, Simon, but that was actually where my thought process was going. If we have a property here and then we put it through the company, creating a director's loan account, but then it goes into the pension fund, and obviously nobody is planning their ultimate expiration, but how many years does it need to be in the pension fund before it can be passed on? Is this something that maybe somebody who has of ill health, who kind of, they have a definitive time frame? Is this another opportunity? Is this an opportunity for effective tax planning into the pension, into the estate?
Yes, yeah, it is. If someone's in that position, then it does need to be dealt with, fairly carefully. Any kind of like deathbed or fairly short run in planning in those sorts of circumstances needs to be dealt with really, really carefully. And one of the things that we need to do is just understand the circumstances of that person and the family. What's the next generation going to need in terms of access to cash, in terms of protection for the future? So I wouldn't say that this is necessarily the go-to solution there. There could be all sorts of things that we need to take into account. But yeah, if you're in that scenario, this is something that's worth considering. And in some cases, it absolutely will be the right thing to do. One of the things that I want to touch on with this is a lot of people will have questions around the personal pension contribution limit. The £40,000 per person per year is the maximum that we can put in, and then there's also a lifetime maximum amount that can go into a personal pension, which is the £1,055,000. Those don't apply to a SAS pension. Those are personal limits, and as I mentioned before, this is a business pension. So a business pension where it's got more than one member can have something called a general fund, and that allows us to make contributions from the company into the pension, which are held almost in a suspense account. When the pension contribution's been made by the company, the corporation tax rules allow that tax deduction to be claimed. The actual allocation of that money from the pension sort of suspense account into people's individual personal allocations, that's governed by this £40,000 a year cap and the £1 million lifetime allowance. But the pension itself can receive a huge amount of money, and then it can have that money sat in that suspense account potentially indefinitely. The earmarking of the fund into people's individual accounts is capped at that 40,000 a year. So when we do this, we have to bear in mind, we need to make those allocations over a number of years to make sure that when people hit retirement, they've got the maximum they can possibly have in their pension fund. But yeah, if people are concerned about these limits, like how can you contribute a commercial property into a pension if you've got that 40,000 limit, that limit again, it doesn't apply here. Totally different set of rules. But yeah, let's run through this example just to sort of bring that to life a little bit more. So Vicky, you can tell I've been using my imagination when I've named these companies for the example. Vicky's got a company called Vicco, and so she personally owns that unit. The company trades from it, values 250,000. Annual rent tends to be 10% of the value of the property, so £25,000 annual rent. And then because she's a high rate taxpayer, she's paying £10,000 a year tax on that. So that's 10 grand a year leakage, and we're going to try and stop that. So her company has regular profits of say £100,000 a year. She sets up a SAS, acquires the property, transfers, the company acquires the property, transfers it into the SAS. And that leaves her with, in this example, it's £100,000 gain. So she's got a £20,000 CGT liability. That's the equivalent of 2 years tax liability on the rent that she's been receiving. So in the scheme of things, £20,000 tax liability, but it's not that big compared to the tax that she's been paying on the rent anyway. Her company claims a £250,000 corporation tax deduction, so that reduces the current year tax liability to zero, and then she's going to get £20,000 reclaim from last year. She's also still got £10,000 of tax saving for next year too, so total tax saving £50,000. The SAS then receives that market rent, so that's £25,000 rent that's going to go into the SAS every year. She was receiving that, and now the SAS is receiving that. So we need to do something to redress that balance to make sure that she's not personally out of pocket through this while building the pension pot. So what she's going to do there is replace the lost rental income by drawing on her director's loan account tax-free £15,000 a year. That lasted for the next 16 years. So over that time, a lot of money goes into the pension, and we end up in a really, really nice tax efficient position. So yeah, if someone's in that position where they can do this, this is a cracking bit of planning for them. And in terms of fees, this is not eye-watering in terms of fees either.
Excellent.
Correct. So what I wanted to touch on next is R&D claims in lockdown. And I'm conscious we've not got a huge amount of time, so I'm going to hit this sort of fairly fast, and then hopefully we can deal with some questions around the pensions and the R&D. If anyone's got any questions, we'll be able to turn to those in sort of 5 or 10 minutes. But yeah, so I'm sure everyone's familiar with research and development tax relief claims. They are a great source of money for innovative businesses. The way it works is you identify some scientific or technological uncertainties that a company's been tackling as part of its business, and then we can claim tax relief on part of the cost. So in effect, it's a way of getting back part of those research and development costs. And it's administered through the tax regime. The claim is actually put in on the CT 600, which means that, that although typically this might be something that you'd expect to see as a grant funding opportunity, but it's something that, as accountants we administer through the tax regime. It's not something that I don't actually handle people's tax returns for that. I always think that's best done by the accountant that's dealing with the rest of the company's affairs. And so yeah, I just want to kind of run through a few points around this. There's been quite a bit of chat on the forums and in groups about R&D claims being a lot harder in lockdown, because a lot of discussion of, well, you need to go and visit the client, you need to really get to know the business to be able to do one of these properly. I just want to dispel a few myths here, because there's a culture has been built up around R&D tax advice that makes it seem more difficult than it has to be. The most important point that I want to get across to you is that the quality of your records is key. And the same as for any other aspect of tax or accountancy work, the quality of your records is absolutely essential. There are far too many assumptions that are made in R&D tax relief claims, and the revenue are really cracking down on that. So what we want to see is some really nicely presented records that just establish that evidence base that explains the claim, so that if someone looks at the claim in due course, then we can point back at these records and say that's why the claim was that specific figure there. And the quality of those records is really important. The service that I'm going to talk about briefly is a software platform that I've built. Well, my developers have built, and that's designed to get those records in place really, really well. And it's something that it's a software as a service product. So it's actually designed for the client to be in the driving seat of doing all that, putting the data in there, and making sure that we've got the right records. One of the most important things that the revenue asks about when they do make inquiries is the start and end dates of your projects. And so they like to see that the companies have got a few different projects going on, rather than just saying, well, it's 10% of everybody's role in the business is to do some sort of innovation. That's not good enough. It never has been. And that sort of percentage basis that people use when they're making R&D claims, it's got to come to an end. Instead, it's got to be a defined project with a start date and an end date. And if you can describe those well and explain why you've picked those dates, then that'll go a long way to satisfying the revenue that you understand the rules, and that you've actually applied the proper thinking in terms of how these projects are described. And the other thing that's really important to explain here as well is that the revenue are looking for 1 or 2 page narratives. They're not looking for 20, 30, 40 pages of jargon and technical language that they don't understand. Clients don't want to explain, the intricacies of all of their sort of technical know-how to anyone, let alone to a tax inspector through the form of this kind of report. And it's really not necessary. The revenue's view on this is they've got a pretty simple checklist that's got a few things that need to be ticked, 4 questions on there, and if you can't explain why a project matches those requirements in 1 or 2 pages, then that's actually something that rings alarm bells for the inspectors when they're looking at it going, what are you trying to hide here? Why have you given me 20 pages of stuff on this? So yeah, if you are looking at, how can we do a claim in lockdown? If you think, well, I need to get 1 or 2 pages of narrative per project, then actually that's a lot more achievable. That means that it is something that you can do sensibly. If you're asking the right questions and you're getting the right information from the client, it's something that can be done remotely. And again, the software that I'll talk about, that's something that allows the client to actually input a lot of that data for you, so that the conversation that you're having isn't a fishing expedition with the client. You're actually talking about, can we describe this differently? Can you give me a bit more information about that? You're hitting the ground running in terms of that conversation. You can go back 2 years. If you haven't done an R&D claim for a client, you can go back 2 years, and then that can give the client a really good cash boost. Typical values that we're looking at: £40,000 a year for a company. If it's a company that's making repeat claims, you're looking more at an average of about £70,000 a year of value coming back into the company. If the company is profit making, then they'll save that tax. If it's not a profit-making company, then the revenue will actually pay an amount across to the company. They'll write them a check, do a bank transfer, and you get, it's not quite the equivalent value, but you do get an awful lot of the value that you would have had if you were a profit-making business. And so yeah, if you're talking to businesses about R&D claims, a great starting point at the moment is to say, how's your business responding to all the disruption of the coronavirus? Have you had to change your products, your processes? It shows that you're interested in what the client is going through at the moment. And also there are a lot of people out there having to be innovative in the way that they do things, having to respond to, well, we can't get access to this material anymore, so we're having to look at different materials that we can use, and we're doing things in different ways, so we need to make this safer, we need to do that differently. So it's a great starting point for that conversation. But yeah, so a quick sort of run through of some lessons from the front line of R&D. I've been doing R&D for 20 years now, and I've been sort of doing an awful lot of it. Over the last 5 years, there have been very, very few inquiries into R&D claims. And I think, universally, people say that they've had very little experience of dealing with revenue inquiries. Because of the position I've got, I do end up handling quite a lot of revenue inquiries from accountants that have made a claim themselves, and then they've got sort of a juicy inquiry, so they pass it across to be dealt with. So I've got some really strong experience of this, and there's been a big change. Inquiries are no longer sort of asking about the innovation in general. You're genuinely doing something innovative. The inquiries are now very, very much more detailed, and it's from inspectors that actually know what they're talking about, particularly in the software environment. The revenue's now got some software experts that they've taught the tax rules to, rather than, as it was a couple of years ago, tax inspectors that they've tried to shoehorn into looking at software claims. And the revenue is aware that people have been pulling the wool over their eyes in terms of what's innovative and what's not in the world of digital and software for years, and so they're cracking down pretty hard on that at the moment. yeah, so the revenue targeting, yeah, specific sectors are getting looked at. Digital is an area that's getting looked at a lot. Engineering and manufacturing as well. We're seeing much more detailed inquiries there. Not so much into the innovation, but around the client's understanding of the rules, and also into the records that are being kept. I've put on there the death of percentage fees. Now, this is something that I can kind of separately bang on about for hours, but we've seen it across every other aspect of professional services, where there's a perceived risk that clients are taking on too much risk because they're overly influenced by the percentage fees that advisors are charging. Then the regulation steps in and kills off the ability to charge a percentage fee or caps it. And we've seen percentage fees in R&D claims anywhere from 5% at the sort of very low end, up to sort of, well, 20% fairly standard, 25, 30, in some cases 35%. And I have on occasion seen people charging 50% of the client's tax refund as a fee, and that is just staggering. And there's been a shift in the revenue, in the treasury, and the political environment around this is now very definitely saying that that this tax relief that's meant to sustain the economy and help the economy grow, they don't really want to be seeing advisors creaming off 30% of that for what should be a relatively easy bit of work. There's been an acknowledgement that actually the R&D rules are poorly designed, but the revenue have to work with what's there at the moment, and really this the sort of perception that percentage fees are skewing the market is something that I think we'll see regulators step in and start to apply some restrictions around that before too long. Fixed fees are really the way that I think we should be going on R&D claims, particularly if it's someone that's into sort of a repeat claim scenario. If they've been making claims for 3 or 4 years, it's very difficult to justify to a client that there needs to be this percentage fee to balance risk and reward. You know, if they know that the claim's going to go through because they've seen it go through 3 or 4 times before, then this concept of a risk-based fee is really sort of out of kilter with client expectations these days. And so I think fixed fees is where we're at on that going forward. The revenue always now ask about the client's understanding of the BIS guidelines. They want to speak to clients, and they want to ask the client, you know, what do you understand of the BIS guidelines? Even though they're not actually called the BIS guidelines anymore, the revenue always uses that terminology. Excuse me. And if the client says, look, never heard of them, then you're in bother. So it's one of these things that you know, we do try and make sure that the clients have got plenty access to help and guidance around that. And then there's certain advisors that are in the spotlight, ones that are known to base their claims on benchmarks and sort of making claims 10 or 15% up or down on the benchmarks that they've got. The revenue are aware of people doing that now, and so they want to see, no, we're not interested in assumptions of benchmarks. We want to see proper records, you know, who did what work over what time frame, linking it in with the start and end dates of projects. And they're not expecting timesheets as such, but the software that we've developed does allow individual staff members to tag their time against these projects, and that is something that the revenue are now saying, given that the technology is there, available and easy to use. Someone who comes along and says, well, I've just taken 20% of his time, 50% of hers, 35% of that person, they're saying, look, that's not good enough. And to be fair, it never has been good enough to make bold assumptions like that. And then also, yeah, the revenue are aware of people that try and blind them with science, you know, producing very thick reports, generally written by retired academics or retired engineers, and these reports are lovely, long flowing things, but don't actually link in with the numbers. The revenue are aware of that and conscious that they want to see where the link is between the figures that go into the claim and the narrative. And again, that's something that the software really helps with. So I just want to give you a couple of really quick examples here. I'm sure everyone's kind of aware of the benefits of R&D claims, but just to quickly illustrate this, a typical example might be someone who's got 25 staff, average salary £25,000 a year. Say 10% of the staff time is spent on proof of concept work. People seem to have to demonstrate their ability to solve problems to win work these days. And so if they've spent, say, £100,000 on materials on that kind of work over the year, then putting your salaries and materials together, 160,000 of qualifying cost, that's going to give you an extra corporation tax deduction of 211,000 there. So that translates into a £40,000 tax saving. So £160,000 spent, £40,000 of tax saved. So that's an absolutely bog standard example that I think everyone will be familiar with. What I want to do in this example is just to illustrate a slightly different angle on it. So let's assume same scenario, but actually the company's been paid by a large company. So that's one that's got more than 500 employees, large turnover or large balance sheet, and so that this large company has paid Phil's fabrication company to carry out some work on an R&D project for the large company. So again, I've kept the figures the same: £100,000 of materials, 10% of all the staff time that's on there. And although I said don't use blanket assumptions, I'm using one for the purposes of the example, so in coming up with that 10%. But yeah, putting your salaries and materials together, it's the same qualifying cost as in the last example. But the SME company can claim as if it was a large company. So it's going to claim the RDEC tax credit rather than the R&D tax relief, enhanced expenditure. So that's the above the line credit, which would be £21,000 in this case. That's a taxable benefit though, taxable credit. So the net benefit is going to be £17,000. So this is one that a lot of people miss, which is why I wanted to highlight it. If the company has been paid to carry out that work, but it's been paid by a large company, then so long as the work was part of the large company's R&D project, your large company can't claim anything that it subcontracts out to SMEs. But the SME can make this claim, even though it's been paid, it can get another £17,000 of benefit there by putting through a claim as though it was a large company for this. And yeah, so that's one that hopefully people will find useful.
Both of them were useful. Well, I've taken lots of notes anyway, Simon. I found both parts of your session extremely beneficial. Simon, in terms of yourself, where do people contact you, or where do people find you, and if today has been of significant interest for them or has rang a bell?
So the best place to get me for anything to do with your SAS pensions, sas-law.com, and my email address simon.britton@sas-law.com. That's the best way of getting hold of me there. I work with SAS administrators, SAS trustees. What I do is the implementation. They set the SAS up. I handle the implementation and work with advisors around making sure that the planning is right, and then that the implementation is right. So that if anyone wants to kick ideas around about how could we use a SAS for this client, then yeah, give me a shout. We're very happy to work through examples there and develop some planning. On the R&D side of things, quantify.tax is that's where you'll find details of the software platform that helps clients put together the R&D claim, and also you can contact me there. More than happy to get involved with any sort of technical queries people have got around R&D. And we've got sort of a tailored service. If it's a client that's comfortable with R&D and wants to manage their fees a bit better, then they can use the software themselves, and we go from there all the way up to sort of reviewing their claims for them, or giving them complete hand-holding consultation service for someone that's never done a claim before. But yeah, so either of those would be a good place to catch me. Yeah, thanks very much for joining in.
Well, Simon, thank you very much. And thank you all of those who have joined us across the various platforms where you're plugging in. Obviously, if you found something of benefit in what Simon has covered today, you have Simon's contact details there. We're going to continue running these webinars throughout COVID-19, and we have a full schedule of free webinars for UK accountants. So please, if you found this of benefit, pass it on to your friends, pass on the next link, the next email that you get. We've got a schedule, we're developing a schedule. We've got some excellent speakers coming up in the month of May and beyond. So on behalf of OmniPro and our entire team, on behalf of myself and Simon, thank you very much. Let's stick together and let's get it done.